EBITDA. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And we're back with another installment of What is that? Where we discuss financial term and topics you may have heard, but we make them super easy to understand. Today, we're talking about EBITDA, earnings before interest, taxes, depreciation, and amortization. So if you're a business owner and you want to learn more about what this is, tune in and let's get started right at the beginning. EBITDA. What is that? EBITDA was first used in the 1980s by investment bankers and analysts who really wanted to understand a company's earnings and compare them to others in different industries. It is still being widely used by investors, lenders, and the like in order to determine what a company's performance is. So where do we find EBITDA? We look to your profit and loss, also known as your income statement. We go to the bottom line, which is known as your net income. And to that number, we add back interest, depreciation, and amortization, as well as taxes, in order to determine what your true net operating profit margin is. EBITDA is useful because it helps us determine what your actual earnings are from your operation, right? What profits are you generating from your operation? And it removes the non-operational factors. For example, if we find out that the EBITDA is decreasing over time, we may also see that operating expenses are increasing rapidly, too much in relation to income, or that the company is experiencing saturation in the market. But EBITDA does have some drawbacks because it doesn't factor things like capital expenditures. This is when you invest in fixed assets. It also doesn't think about working capital changes. For example, when you take on debt or a line of credit to fund operations. So because of this, it's actually common that most business owners want to use EBITDA because it makes their company look better. In fact, sometimes an important red flag for investors in a company is when management starts to emphasize EBITDA more than net income when they were emphasizing net income in the past. When companies have borrowed heavily, or when companies are investing significantly in assets that will bring them revenue in the future, they lean towards EBITDA. Let's look at EBITDA, forget about depreciation, amortization, and interest. Don't think about our loans. Don't think about what we're investing in our assets. Let's just look at what our core operation is doing. So when analyzing a company's profit and loss and income statement, you do want to factor EBITDA, but you don't want to let it distract you from the challenges a company might be facing by placing too much emphasis on EBITDA. We hope you enjoyed this latest installment of What is that? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.